Hi, everybody, and welcome to the Middle Class Investor this week. This is Seth Martin, your host. It is Sunday, November 26th. I hope everybody had a happy Thanksgiving and relaxing and got to spend time with family and friends and hopefully didn't eat too much and didn't bust the diet. But anyway, we're looking today. We're going to look at the charts that we normally look at, and I'm going to talk a little bit about, I'm going to show you an article. I get a weekly article from a guy named John Malden. I'll probably end up posting it to my Middle Class Investor Twitter account, but I want to show you some stuff in there. The market keeps going up, and that's a little bit problematic. I've got kind of it's kind of a risky, I guess, risky options trade on. And you can see this week it really killed me. I put it on somewhere in here for March of this year. In fact, I'll show you what I did. Not necessarily recommending that anybody else do this, but let's look at the Dow and the S&P first. Here's the S&P since 2016. We've got kind of a 5-wave move up. The market continues to, every time it does one of these, once you see 5 waves, like here's 3 and then 4, and then really as soon as you count 5, the first time we counted 5 was right about here. So let me zoom in and show you that. So the first time we counted 5 waves was right about here. So when it pulls back and then goes up, that's an extension. It pulls back, it goes up, then it's extension. Then it pulled back and went up, and that's an extension. So 5 waves could have ended here, but we've pulled back. We've pulled back, ran up, pulled back, ran up, pulled back here. So obviously, one of the things you can tell is these get smaller and smaller, both in time and in magnitude. We could measure these if you. In fact, let's just do that. This one right here. Let's get on a daily chart, or let's get on a daily chart and measure some of these. So, whoops. Let me zoom in first. It won't let me zoom in with that tool on. So what we're going to do, we're going to zoom in on these, and I'm going to measure them. So this. Once 5 waves is complete, we see we had this pullback. So from here to here was 75 points down, roughly 3%, and it took almost 57 days. Is that right? That can't be right. No, that's not right. 57 days. That can't be right. 13 days. Excuse me. 13 days. 57 days. What am I thinking about? So anyway, that took 13 days. So the next pullback, which was right here, you can see that was about 34 points, and it only took about 1.5 days. And then the most recent. Actually, you know what? That's not one. That's the 4th wave in that move. Hold on. This is the one I was looking for right here. Sorry about that. So right in here to here, that was 39 points, and it took about 8 days. So the first one took 32 or 14 days. This one took 8, and then so obviously, I mean, this could run up and extend. And instead of having an 8-day pullback, it could have maybe a 5-day pullback or something like that, and then extend again, and then pull back for 3 days and extend again. I mean, this could go on for a while. It doesn't have to, and it could very well be over, but that's just what's happening. That's why picking a top that's one of the reasons why picking a top is not a very fruitful exercise. Now, I did come in here and buy an out of the money option because my feeling is that we're going to come back to this area fairly quickly, this blue area right here. What I mean by fairly quickly is I mean within a few months. So what I did is I bought a way out of the money option. I'll show you. This is a paper money account, but I'll show you which one I bought. I bought this March 2018. Now, it had a lot more days on it when I bought it. It had 140 or something like that when I bought it. And this is the option right here. Of course, this pricing is not accurate. But the idea is, and I bought it on the Dow, so you can see this is the DI. Well, you can't see, but just trust me, this is the DIA, which is the ETF for the Dow Jones Industrial Average. So how does that work? Not that I'm recommending, in fact, I don't recommend anything on here, but I'm not recommending that you necessarily take this trade. But let's say our target is right here. Let me go ahead and mark it. I just want to, this is what some people do also to buy insurance. So let's just say that our target is right about there, 148. Let's say it's 148, okay? And let's say that we think it could get there by June, okay? Well, we don't necessarily want to buy the 148 option, but what we could do is we could buy, an option around here, around 205, let's say. So let's mark that area, around 205. We could buy the 205 strike, okay? And that means it has to travel all this way before it has to travel to 205 just to break even, okay? But here's the thing. If you can get an option like that, let's say we go out and we buy the June, which is 200 days. So that means by June, we're expecting this to happen. Well, the June 205 strike right now is selling for about 240. So if I went and bought 5 contracts of that, that'd be about $1,200. Okay, so remember that, $1,200. And then what we're saying though is if the market gets down to all the way down to, oops, wrong way. Let me go back to the chart. If the market gets down, if it actually comes down to this area before that expires, then that option will be worth 205 minus 148. So I'm not sure what that is, but it's a pretty decent number. It's like $43. So that'd be about a $22,000 gain, because you would take the difference between these, so 205 minus 148, which is $43, right? Is that right? 43? 48, it'd be 48, yeah, $43. So 43 times 5 contracts times 100, because each contract represents 100 shares. So you could, if you believed that to be the case, you could buy that option for $2.40 today, hopefully sometime between now and June. Now, if it got down, let's say, to 185 and started to bounce and looked like it was going to take a lot longer to get down here, then you could go ahead and sell it early, and you wouldn't make $20,000, but you might make $6,000 or $8,000. So anyway, these are the only time you can really do this is near tops like this, where the volatility is really low. And the reason is if you look right here, this is the implied volatility of the option. And what I'll do is when the market starts to sell off, I'll point out the new volatility. This is an arbitrary kind of number that, well, it's not entirely arbitrary, but it's almost arbitrary. It's a number that market makers put on the price of options to either encourage or discourage people to buy. So it's kind of like when you bet on a football game and they're giving points. It says the Cowboys plus 10, meaning what happens is as more and more people bet on one side, the bookie will move that points. They might move it from plus 10 to plus 8 or to plus 6 if too many people are given the points and taking the opposite team. So or taking the Cowboys. And what they'll do is if too many people are taking the Cowboys, they'll make that point spread even bigger. It'll go from 8 to 10 to 15 until more and more people start taking the other team, say the Houston Texans. And the reason that is because as a bookie, really what you're trying to do is you're trying to balance the market. You're trying to have the same amount of money for the Cowboys as you have on the Houston Texans. And the market is very similar. So the way they don't have a point spread, what they have is they have implied volatility. So as implied volatility moves higher, it discourages people from buying long directional options and incentivize them to sell them. So it helps them move people from one side of the market to the other. And I'll point it out later when the market sells off a little bit about how high. Right now, this implied volatility is very, very low. What that says is that people really don't expect. I mean, if you compare that to the front month, let's look at the front month volatility. Front month is right here. So the front month volatility is 11%. So what they're saying there's not going to be much difference between this month's pricing and June's pricing. Well, what happens is that the market starts to sell off, or even if it runs up really big, you'll see those numbers start to increase, especially if it falls, if the market falls. So my only reason to bringing all that up is this kind of trade is only possible really when implied volatility is very low, because what you're doing again is you're buying an option that says, if the market goes down, I want to make more money. So you're buying the put side over here. If you thought the market was going to go up and you thought it was going to go up very quickly, you could buy, the call side over here. Calls are over here, puts are over here. Now on your brokerage it may be different, but that's the way it is for TD Ameritrade. All right. So let's go look at some more charts. Kind of got into a little bit of a divergence there. Let me go to a 5-year chart. We don't need to look at a 10. And since we talked about volatility, let's see what volatility is. Now, this volatility that we're talking about is the S&P 500 volatility index. And you can see here that we are way, way low on the volatility scale. And I mean, just all along here, these are like 50-year lows in volatility. So a lot of complacency. A lot of people think the market's going to just continue to go up, and maybe it will, but long periods of low volatility are usually followed by high periods of high volatility. So that may sound intuitive, but it catches people all the time. Let's look at some of these countries. We haven't really spent a lot of time looking at these countries in a while, but you can see Germany is still moving up into this area. We've had this area on here forever, and now we're in an area of resistance. So that doesn't mean that the market has to roll over here. It just means if you're betting, if you have shares on the DAX, you need to be aware that you're in an area that could present some selling in the future here. Maybe back down into this area, at least down into this 30 area. Japan continues to print money and do all kinds of crazy stuff. The BOJ owns, I don't know, like crazy amounts of Apple and all kinds of U.S. stocks. So does the Swiss National Bank. You just got really crazy things happening. Sorry about that. I hit the wrong button. Let me see if I can get out of this. Okay. Not going to be able to get out of it. So let me try something different. There we go. All right. Sorry about that. Yeah, so the Swiss National Bank owns a lot of U.S. equities. If you listen to Peter Schiff, he actually gives you the numbers, crazy numbers. I mean, Normally, national banks don't own equities because equities, especially compared to bonds, can be quite volatile. The UK, you can see the UK is channeling here. Could be in an uptrend, but I don't know. This so far, this is all inside parallel lines, um, which may mean that it's a correction. Let's look at interest rates. Look at the 13-week Treasury. You can see here that the 13-week Treasury has been on a tear recently. Excuse me. Got a nice little, curve up here. Looks like we could pull back some. I mean, sometimes you'll see one of these at the very top of a trend, so you get some sort of pullback, maybe down into here, and then maybe a rally up again. The Fed, I think, the jig is up. They're going to be raising rates. I think everybody's pretty much in that camp now. The 10-year Treasury, which is probably the most, continue to say, and here's the most important interest rate that there is, could pull back into here. And then we should see a really dramatic move. Something that looks similar to this right in here. This is pretty typical of third wave action, except this will be a third wave of the next higher degree trend. So, what's a good estimate here? That's probably something that some of you'd want to know about. I would say that at least you should at least see a move. Let me get the Fibonacci number on here. Sorry, got a little dry spot in my throat. Let's put a 10-year up. Maybe 4.5%, 4.7%. Now it may come here and kind of rest a little bit, pull back, and then come up. But you should probably see you should see this double in the next 6 months or so. And that is not going to be good for bondholders, okay? This is going to be a lot of money. This move from right here to here, you're talking about trillions of dollars lost in the bond market. Trillions, okay? Big money losses. So, if you're in those bond funds, you might have one more chance here as this pulls back a little bit further. But your chances are starting to run out. So be very, very careful. Let's go back to a 5-year. Excuse me. All right. Let's put up the other charting system. And let's look at gold. We talked about how gold was kind of in the middle of no man's land, but likely going to pull up into here. And I still say that's probably the case where, this is too short. All this is too short for a B wave. So probably what we've got is an ABC up into here, and then ABC pullback, and then a 5-wave C into here that's going to take us probably into 2020. I mean, you can see gold go up into 2020 and then turn around and sell off over the next 3 years or so into the final C wave down. The big picture is, so maybe we can draw it. Maybe that'll help you kind of see what I'm talking about. Let's just draw some lines on here. So you might see, ABC up into here, and then ABC back down to here ish, below this pivot, okay, just below that pivot, and then a 5-wave move from here. I can get this thing to cooperate, maybe up into, this area, something like that. And then, big deflation down. So it's possible that this could make a lower low, and that the A, B, C turns out more to be a flat pattern, which means 1500 would be about the height. So the other scenario is that this ABC comes up in here, B actually comes lower, okay, lower than this one. And then the C wave is actually not as high. It's about the same height. So here, and then down. Okay, so that's also possible. Those are very common. The other scenario here, you can see that it's not quite taken out this high yet. So the other scenario is we could go down here and end up making a triangle for the B wave. Okay, so in other words, A, B, and then C, and then down. So triangle could be something like so. I hope this isn't confusing anybody. So A, B, C, D, E. Okay, and then up and C, and then down. So these are all different scenarios that gold could follow. They all do basically the same thing, except there's just the extremes are different, inside here. So and I would expect silver to do something similar. Okay, we don't need to go draw the different silver options, but suffice it to say, this is here's what we do know. Let me look at it. Let me approach it this way. This appears to be the first wave in a new bull market. And we know that after the first wave in a new bull market, we have some sort of correction. Okay, so some sort of wave two here. So wave two take the form of some ABC, and that ABCB especially could take the form of something that we have not yet seen. Okay, so and then somewhere around in here, maybe 2026 or something, you'll see a low in gold, and then you're going to see wave three, which would for the next 20 years you're just going to see massive inflation as the dollar gets just routed. Okay, so you need to be if I were you, I'd be thinking about this and be thinking about, okay, how if the United States chooses to go the way of Venezuela, which here's the thing about that. Some people, oh, we would never do that. I mean, I talk to people all the time. Oh, they're never going to. The United States is never going to do that. People aren't going to put up with it. Blah blah blah. Maybe so. I mean, that could be. But let me say this: no government in the history of the world has ever done the right thing by its money. Okay, every government, every single one, has when given the opportunity to do the right thing, they do the absolute wrong thing, and they try to inflate away. Okay, this is to the masses, this is an easy way to steal from the public. Most people don't know what inflation is. They think inflation is a naturally occurring thing that just happens in an economy, and they don't understand that governments create inflation. And if they do understand that, they certainly don't understand how. So it's just something you need to be aware of. Is it something to worry about? No. You just deal with it. That's the thing about the market. You don't worry about the market. The market tells you what to do, and you just follow it. But no government is bigger than the market. Especially now, we have a world market. Okay, there's no government, even as powerful as the U.S. government is, not powerful enough to control the market. Absolutely not going to happen. So it can either do the right thing by the market, or it can continue to try to manipulate the market, and the people will suffer. Those are the options. All right, let's go back to a weekly. Let's just stick with I don't know. I was going to stick with a 3-year, but let's do the longer term. All right, let's look at the euro US dollar. It looks like here I was looking for the euro to go back down. At this point, it doesn't look like that's going to happen. Looks like the euro wants to go higher to at least here. We can put a box there. Let me go up here and grab a box. So at least off this pivot here. So we should see the euro continue to climb up into this area before we see any kind of selling action. All the currencies are really confusing me right now. I just have to be honest. It's one of these things where I thought I knew what I was looking at, and they haven't proven proven me right. So again, I think the British pound is a good one to be long. Was hoping for a pullback here. I guess we pretty much got it right there. That was it. That was all we were going to get, you know. So kind of a bummer there. I was hoping we'd get a pullback at least further into this box and then give me an opportunity to get long the British pound. Just wasn't in the cards. Oh, that's the GBP. Never mind. Let me look at the British pound US dollar. Okay. This is the British pound US dollar. So went up into resistance here. That was the British pound JPY, by the way. So, you know, it was looking for, you know, this to pull back down into this area. And as of right now, it hasn't done it. So we've gone exactly to the 200%. We're probably going to make a new high here is my guess. And then probably roll over. But still think the British pound, if you can find a good place to get in, you know, somewhere around here, this 1.27, 1.25 area would be excellent area to get long the British pound, I think. But you're going to have to watch it. Let's look at oil. Oil, you know, pulled back. We thought it was, you know, we, meaning me, thought it would pull down into this area. Instead, it pulled up into this area. So you can see here we've got a little pivot. It's probably going to that pivot. You see the pivot right here. I can get something to stick. So you can see this pivot. So this box here is off of this pivot. So look for oil to, you know, to kind of run into some resistance here, maybe roll over. Oil could be making a triangle. We clearly have 5 waves here, 1, 2, 3, 4, 5. Okay, and then we could have a triangle happening where this is all A, so A, you know, A, B, C, or whatever, and then down, but not all the way down, then up, then down, you know, so on and so forth, and then resolve itself to the downside. Triangles are continuation patterns, so the trend is in this direction. The thing about triangles is once you have one, it's also a trend termination pattern. So if this is the direction of the trend and this is a triangle, then that means that's it for this particular trend. Meaning we're not going to have a 4 and a 5 and a 4 and a 5 and a 4 and a 5 and that kind of thing, like we talked about earlier. All right. So, guys, is there anything we hadn't talked about? Let's look at this Malden newsletter. Whoops. So, one of the things he talks about is leverage, calls it the American style. And he's showing the U.S. credit market as a percentage of GDP. And let me just zoom in here so you can see these milestones. It's kind of not great, but I'll talk you through it. So this is the Great Depression, where debt as a function of GDP got to 299%. And you can see here's 1987, 230%. Stock market crash of 2000, 275%. 2008 crash, 371%. And here we are. We peaked here at 378. And this data, I think, is a little bit delayed. But ultimately, this could end up being, you know, maybe we're actually right up here now. You know, we could be here, let's say, and about to roll over. But we're close to 400% of GDP, of world GDP. Okay, so this is debt all over the world, and the reason we're talking about the world is because, you know, it's a global market. I mean, that's just the reality. I mean, if Japan has some sort of debt crisis, or China, it's likely to spill over into the U.S. Okay. So here's some talk that he does about contrarianism and against the crowd, and he brings up this exposure to the markets versus cash. And we've talked about this. We've got record you can see here we peaked 21% Merrill Lynch clients were holding cash in February 2009. Now, in almost 2018, we only have 10% of the clients are holding cash. So what does that mean? Where's the rest of their money? Well, the rest of their money is in equities. And you can see here that we're even lower than we were during the financial crisis. So the financial crisis hit here, and people went to cash over this period of time. And then over time, they've slowly gone back into equities. More and more of their money been reinvested in equities. Now we're at 10.4%. So it's something to be aware of. It's obviously, if you're getting in, if you're taking new money and putting in the market, there's a lot of risk there. Here's some interesting. He says, anyone questioning whether the financial markets are in a bubble should consider what we witnessed in 2017. So he says a painting, which may be fake, sold for $450 million. Bitcoin, which may be worthless, we don't know, right? We're not sure, soared nearly 700% from $952 to $8,000. The Bank of Japan and European Central Bank bought $2 trillion of assets. Now, most of these assets were mortgage-backed securities and sovereign bonds, but as I mentioned, some of it was stock also. Global debt rose above $225 trillion to more than 324% of global GDP. U.S. corporations sold a record $1.75 trillion in bonds. European high-yield bonds traded at a yield under 2%. So high-yield bonds usually, they're normally trading between, 7 and 12%, something like, sometimes even higher, sometimes around 15% or so. Argentina, a serial defaulter, sold 100-year bonds in an oversubscribed offer. That means there were more people who wanted to buy them than they actually were trying to sell. It says Illinois, hopelessly insolvent, sold 3.75% bonds to bondholders fighting for allocations. So here's a state that's almost for sure going to go bankrupt, and they sold bonds at 3.75%. That means they got a pretty good, a lot of money came in for this 3.75%. They got paid a lot for these bonds. Global stock market capitalization skyrocketed by $15 trillion. That's just in 2017 to over $85 trillion, a record 113% of GDP. The market cap of the FANGs increased by more than $1 trillion. So the FANGs are Facebook, Apple, I forgot what N is, and then Google. I wonder why I can't think of N. Amazon? No, it's kind of Amazon. Facebook, Apple, something, and Google. S&P 500 volatility dropped to a 50-year low. 50-year low. And Treasury volatility, 30-year lows. So what is that saying? That's saying people think the market's going to continue to go up, and people think the bond market is continuing to go up. Money-losing Tesla, and you see how he feels about Tesla, sold 5% bonds with no covenants as it burned through $4 billion in cash and produced very few cars. So no covenants. You don't have to give up part of their company or anything like that if they default on these. They just default and you're screwed. So there's some interesting facts, okay? Now here's another interesting chart. This talks about liquidity and how it correlates to the Fed's balance sheet. So you can see here in the 2009 low, liquidity fell, right? And of course the market fell, okay? So they're correlated. And then the Fed came in and said, here's $1 trillion or whatever, and the market started to go up. You see the market going up in a way. Now it started to flatten out, and the market sold off, right? And then it started to make its final push to the high. So now this orange line here is the expected withdrawal of liquidity. So we had the Fed, this dotted line is the Fed putting liquidity into the system, to the banks, And this orange line is the proposed, withdrawing of that liquidity. This has to be done, okay? There's no way to get around it. They have to lower the value of their balance sheet. They can't carry $4.5 trillion on their balance sheet forever. Their balance sheet really should have nothing on it, or very little on it. Over time, it should average to almost zero. So that looks like a big time problem there. VIX futures, you can see, what they're doing is this is the 1-day return on VIX futures, and you can see that look how many contracts there are. There's 400,000 contracts. Inverse ETP hedging, dealer gamma, and leveraged ETP rebalance. So what's happening here is, like, if you let me just show you real quick. If you buy, and I own some of these, so it's not like you shouldn't buy it. You just need to be aware of it if you do buy it. But let's look at SDS. SDS is a leveraged ETF. 2 times for the S&P 500, so it's a short. So if the S&P 500 goes up 1%, this goes down 2%. Okay, so you can see here, but what's important to see here is over time this loses money, and the reason is because of all this futures activity over here on leveraged inverse ETPF hedging. So they're having to buy and sell these futures in order to hedge their positions, so that these inverse ETFs and other ETFs can follow the market. So that's one thing you need to be careful of when you buy ETFs. Now the SPY or the DIA, you can see those track the market pretty accurately. DIA is this, but once you get beyond, or the QQQ, that's for the NASDAQ. Once you get beyond those three, you got to really watch how much money, what their expenses are on these ETFs, because they cost money to create. And not only do they, it's like when they create them, they don't just create them the first time. There's an ongoing creation effort. Okay, so that costs money. Somebody's got to be trading those futures in order to have those ETFs track the way they're supposed to track. So just a little side note there. Thought I'd mention it. I will. I'll put the John Malden email. I'll send it to my Twitter. I'm pretty sure I can tweet this. Yeah, right here. And that way you guys can have it. Tweet. There, it's all done. So if you want to read that article and look at the links he's got, you can also subscribe down here at the bottom if you're interested in John Malden's. He's really an interesting guy to read, and it doesn't take too much to read. I think he comes out once a week, and it doesn't take a lot of effort to read his newsletter. So you can subscribers at maldeneconomics.com. So you can send him an email and say, hey, I'd like to subscribe to your newsletter, and he'll put you on there. All right, everybody, that is it for this week's Middle Class Investor. Let's just take one last look at, let's close that and open that, and let's take one last look at the S&P 500. I don't know why that is doing that, but that is so sensitive there. I can't even, there we go. I don't know why it's doing that. So you can see here, and I mentioned this last time, we're at this juncture where, we have this long-term trend channel, this intermediate-term trend channel, the midpoint of it, and this shorter-term trend channel are all stretched, okay? And we had this location drawn on there, and we're at that location again. We came down, looked like maybe that was going to be it, but this rallied to a new high, so we might have another little down up to some new highs, maybe around, I was looking at this the other day, maybe around 26.15 or so, something like that. Let's put that on the chart so that we can refer to it later. That's about what I see as 26.15. It's hard for me to see more than that. Now that doesn't mean there couldn't be more than that. It's just it would take another down up, sequence, and guys that do this charting, there has to be, for every down up, there needs to be a 1, 2, 3 somewhere. So it's getting harder and harder to find the beginning, the 1, 2, 3, 4, 5s that would correspond with another 4, 5, 4, 5. So there's only so many of these in here. It's just when these final degrees of trend finish unfolding, then we'll start having some down price action. And that's the way the fractal works. So, all right, everybody. Hope that was good for you. As far as I know right now, I'll be back next week. I skipped last week because Thanksgiving was coming up and I was going out of town. And I will be out of town the week of December 17th as well. But continue to be on here and help give you some feedback on these markets. And if you have any questions, feel free to ask them here on the comment section, and I will reply. All right, everybody, thanks a lot, and go to at investor class. That's what it is, at the @ investor class. If you want to get that John Meldon email and subscribe to him. Okay. All right, everybody, take care. Thanks. Bye bye.